Per usual, loading on this channel is for educational purposes only and is not intended as financial advice. It is Macro Monday, and it's a bloody Monday, tax day in the US. Of course, lots of money that would otherwise be buying the dip in many places is currently being sent to the IRS. That certainly helps move markets lower across the board, liquidity down, geopolitical risk up, things like that. Starting with the weekly global flows from James, no surprise here, we're negative 126 million on the week. Once again, we have flows coming out of ETH, multi-asset, Solana, along with Bitcoin, of course, most of that being GBTC. Germany, for some reason, saw some inflows last week. But generally across the board, it's been soft, flat, down, chop, angry, more bearish than bullish. We did get the approval of the spot Bitcoin and ETH ETFs in Hong Kong. Eric, of course, immediately commenting on his expertise here, putting some cold water on any wildly bullish expectations. The market is smaller, there's less issuers, BlackRock's not involved, fees are likely higher. So, as he says here, it'll be additive, but probably not to a massive degree. And something else to pay attention to in regards to the HK stuff is whether or not the ETFs will be involved in the Southbound Connect program, which allows mainland Chinese investors to buy. I've heard that the institutions may be able to buy via that program, but I don't think retail is able to. I'm sure we'll find out here in the coming weeks, but I wouldn't expect flows to be as bullish as US flows, definitely. Bitcoin remains hyper volatile, again, thanks to Middle East headline risk, effectively geopolitical risk, stuff like that, war escalation. Certainly not helping our case here. The four horsemen of the apocalypse, when it comes to risk assets, I'll talk about that in a second, those continue to move up. So look, if we are risk assets in somebody's portfolio, we move down. It's that simple. The higher yields go, the easier it is to sell something like BTC or an altcoin that's up 1,000% in 6 months, and then just T-bill and chill, baby. T-bill and chill and just relax. 1 month, 2 month, 3 month, come back in a couple weeks or a quarter, whatever it is, when the market structure looks more favorable, at the very least, across the board, everything again. Legacy looks as bad today as alts did Thursday and Friday. So I don't think Legacy is going to collapse as fast as alts did, but Legacy continues to not look pretty for the bulls. And if we want to look at and talk about the real Bitcoin chart, the IBIT ETF chart, I cannot see a bullish argument here. Let me know in the comments. I'd love to hear it. I don't want to be bearish, but this needs to resolve or clear or reset. Something needs to happen here, or nothing for an extended period of time, right? That's always the argument. This either needs to resolve the bearish consolidation or the bullish rejection, however you want to think about this, or just continue to chop for a very long time. But this does not look bullish to me. Whether you call this a triangle, an ascending triangle, a head and shoulders, an Adam and Eve, whatever, all of it looks bearish, definitely. One reason to look at this chart over the Bitcoin spot chart is just because we tend to have more noise on the weekends. We tend to have more chop on the weekends, less maybe real price action on the weekends. Just something to think about. We, of course, had open interest come down pretty significantly. My issue with the open interest doomers saying that, open interest is at X billion dollars, it has to come down. Looking at this cycle to cycle, there's really no level where you can say this looks like this is the top, right? Anything past the previous high of 25 billion, you could have said, oh, this has to come down, this has to come down. Towards the end, it made more sense when it stopped going up, perhaps. Maybe the limit is, 2x the previous high or something logical like that. But I certainly don't think open interest is necessarily going to go back down to like 20 billion or less or something like that. I don't think that needs to happen, but obviously we'll be continuing to watch that one. And funding has flipped negative for Bitcoin here and many assets for the first time in quite some time. And I know I keep saying this, but if we want to reset, which I do, just, do it. Go negative, get bearish, flip below the cloud, whatever you need to do, get that out of your system. And we'll come back to it in a couple weeks and pick up the pieces. But I don't think the bulls are in control at the moment based on price action. Of course, this was the headline. Israel looking to hit back at Iran, and that sort of sent everything tumbling, including BTC, which had quite the nice rally last night. And one last thing about the crypto side, we did have more potential regulatory stuff coming out of the UK. They tend to be more hostile, I would argue, than helpful, but maybe that'll help pave the way for US stablecoin legislation eventually down the road, or even better definitions of what a security is in the United States on the crypto side. Before we go deeper into macro, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Once again, coming back to PAXG, which continues to look great against Bitcoin as Bitcoin rolls over. And it kind of makes me wonder in a couple of years whether or not we're going to see continuous tokenization of commodities, real world assets that are tradable on a 24/7 basis versus something like 5.5 days a week, right? Now, there are, of course, issues with custody and management of custody and trust in the stablecoin itself. And if we can get that nailed down, I think we eventually will see more of a blend of on-chain, off-chain tradable assets like PAXG or Tether Gold or whatever else. And if we look at alts today, once again, most things against Bitcoin are not looking so hot. I'll say most, we'll say half of this list, okay? There was a bit of a dislocation for Bitcoin today, and in that it's down more than ETH. I don't think there's a great reason for that, but if Bitcoin is in more portfolios than alts, maybe that's one rationale. Doge BTC up 6% today. But on balance, I certainly don't expect alts to suddenly outperform if legacy and Bitcoin start to roll over. Looking at the calendar this week, lots of Fed speak all over the place every day. It's kind of relentless. JPY. Tomorrow, probably the most important of the week, but it just continues more. Every single day, one of these Fed speakers is going to say something that the markets may like or may not like or whatever, right? So keep that in mind. The big kahuna is next week. We've got GDP and PCE, both of which I would argue headed in the right direction for economic health. PCE down, GDP sideways and up. If we look at GDP, it is starting to curl up. And once again, there's this argument, if we're spending what we're spending, if the debt is what it is, we better see a positive GDP out of that. It's the debt to GDP ratio. It's probably a bigger problem. But certainly based on recessionary conditions of the NBER definition of a recession, we are definitely nowhere near a recession based on GDP, which is 2 negative quarters in a row of GDP. Looking at where that GDP growth has come from, I believe this is current. There isn't a date on this, but I believe this is as of recent data, as it kind of says in the subheading here. Mining, quarrying, oil and gas extraction industries have provided the largest GDP growth in the top 5 states: North Dakota, Texas, Wyoming, Alaska, Oklahoma. Much of the GDP growth coming from the middle of the country. This was 2023. So as energy continues to be a priority, that may continue for those states. But again, there's really no data reason why we would be in a recession right now. Even though for many people, it certainly feels like that because of inflation, because of layoffs. I have 5 people in my immediate circle who have been laid off in the past month from their positions of various markets around the country, different types of jobs, high skill, low skill. Hasn't really mattered. And you know what they say, it's a recession when your neighbor loses their job. It's a depression when you lose yours. Looking at trueflation, we've continued to diverge from CPI. Last CPI was 3.5, so that's incorrect on the website here, but this may be one of the largest spreads of CPI and trueflation. They aren't one-to-one. They don't have the same baskets necessarily. They don't use the exact same data. So as encouraging as this may be, it really doesn't have a realistic bearing on the decision of the Fed. Based on their numbers, based on rising CPI, if you were a Fed chair, you would argue, hey, why would we cut right now? Unemployment's fine based on their numbers. Again, maybe not reality, but based on their numbers, and inflation is rising. On the other hand, you could argue, well, PCE is coming down and unemployment is starting to tick up. Maybe we should cut, right? And we might hear that from Powell on May 1st or this week. Who knows what any of these Fed speakers are going to say. Some of them are dovish, some of them are hawkish, some of them want money printing, some of them are more focused on the jobs market versus the inflation piece. So I don't think there's a clear path to cut versus hike here, and that's basically what the market is pricing in. This is the meeting probabilities, essentially 100% probability that we see no cut or hike in the next meeting, and increasingly higher probabilities that we don't see a cut until September. And at this point, the market's only pricing in 2 cuts for the year. And that is a drastic difference from the beginning of the year. And one of the reasons why maybe legacy is rolling over. There was this expectation that rates are going to come down, yields are going to be less burdensome for banks, small businesses, whoever else that relies on lower rather than higher yields. But the reality is that has not happened. The conditions continue to look like yields will remain higher for longer. We joke about that on this channel, but that's what it looks like. We haven't seen the data to suggest cuts. It just hasn't happened. Month over month CPI looks like it may come down a smidge. When this gets reported, the headline number is a rounded value. So if this is like 3.6, it'll probably get rounded to month over month being the same. The PCE out next week, that has come down and is projected to continue to come down month over month. And if Powell wants to point to anything that suggests cuts eventually this year, it could be PCE instead of CPI. Back to the liquidity discussion for a second. Reverse repo down to 327 billion. And as I've said a bunch on this channel, that this represents money buying government debt sort of without impunity from the risk markets. So risk markets haven't really been hit with punishment of the debt issuance and potentially higher yields because a lot of that debt buying has come from the reverse repo. So as this draws to a close here, the Fed, as many have suggested, will have to do something if they don't want things to start to explode. And as easy as it is to forecast something's happening soon, the sky's going to fall, just you wait. We kind of need to see that first before markets can turn around, right? Or Bitcoin can turn around, or risk market, whatever. We need to see something explode first. So it's easy to anticipate that, but this is just another reason why the liquidity picture is going to get challenged and continue to get challenged in the near term. If this gets drained to near zero, yields probably continue to go up. I'll talk about UJ in a second, but if UJ goes to 155, Japan may sell their US bonds and treasuries or whatever they're holding, and that may push yields even higher. And then things could get extremely interesting. If we look at US yields on the long end, especially week over week here, what we've got on our hands now is a bear steepener. We're seeing the long end increase on the yield curve versus the short end falling. That would be a bull steepener. So yields up, prices down on the long end. Short end, again, T-bill and chill is where it's at. The short end, 1, 2, 3 month continues to make sense to me if you're looking for downside protection, waiting for better market conditions. And if you're curious on what a bear steepener is, I'll put this in the description of the video. But it's generally not bullish for markets, at least while it's happening. Bear steepener commonly occurs when investors are concerned about inflation or bearish stock market in the short term. And if we look at some data, how have things performed after bear steepeners? It's actually quite a bullish picture. It's just while it's happening, it doesn't feel so great, right? And if we look at the inverted yield curve, it is trying to close. It's been trying to close for months now and just sort of hovering around the same level on the 10-2. Unemployment, of course, just hanging out down there as well. So as these dominoes start to fall, whether that's UJ to 155, the reverse repo running out, QT having a bigger outsized effect, all these pressures are going to continue to act as a headwind for risk markets. In the United States, if we look at the seasonally adjusted unemployment rates, certainly varying significantly from state to state. And I know the Republican-minded folk like to point to the high unemployment in blue states I wouldn't say that's universally the case, but it certainly looks to be somewhat of a trend. But there's pretty wide variation across all 50 states here. And so really it's maybe not the states that are already showing significant unemployment that we have to worry about. Maybe it's those states that had been holding us lower that may flip to higher unemployment. Looking at that GDP picture, just comparing the states, doesn't quite match up either. The states down the middle of the country essentially providing the most positive GDP. Not all of them are seeing a great employment picture currently, but definitely high variation all across the country, which I don't think honestly gets enough press. We see one number, we think it applies to everything, and that's definitely not the case. So looking at the four horsemen of the risk apocalypse, it is Dixie higher today, gold higher today, oil kind of all over the place, but trying to close higher on the day, and 10-year yields continue to push higher. All of these on trend remain very bullish, and it's just going to be very hard for risk assets to do well. As legacy starts to roll over, there's even more of a reason to, again, T-bill and chill. Just hold on to short-term treasuries, wait until things look better, because the momentum on the risk side just doesn't really make sense at the moment. I think the bigger issue, the broader issue, is if DXY on a technical basis actually breaks out anywhere near 108, and that probably means Bitcoin sub 60, I'd imagine, 60K. I've talked about this diamond bottom pattern or whatever you want to call it for a while now. Certainly didn't think and hope it would play out. So this is kind of scary to see if this does break to new multi-month highs, because we are higher for longer and everyone else is cutting. It makes sense. Logically, the dollar should go up, but that's certainly not going to help risk assets. It's not going to help emerging markets. Here's the inverse of that, essentially, which is the euro. And the euro has looked bearish for quite some time now. It's really struggled with anything above 110. Kind of similar to ETH BTC. It's got this multi-month M double top below the daily cloud. Just no bullishness here whatsoever. First stop would be the local low at 105, but the ultimate target is basically parity again at a 1-to-1 ratio. DXY and euro basically go hand in hand. So if the euro does collapse, DXY will go higher. Euro is most of that basket. Then we have UJ, which is making multi-year highs. And the question everyone's asking is, will the BOJ intervene? And then what will that mean for yields? Because this doesn't look like it's stopping anytime soon. I mean, this looks like XLE. This is a technical ascending triangle. Trend is clearly very bullish. And this measures to quite a high level, well above the previous 150 crisis level. So certainly not bullish for the yen. Then, of course, we've got gold. If we measure the multi-year inverted head and shoulders, somewhere in the ballpark of the target, we're close to it. Gold certainly on quite a run here in the past month. I don't realistically know how much more is in the tank in the near term for gold, but it's obviously bullish, right? The rest of the world is giving you reasons to be bullish gold here. And then back to yields, we've got TLT. If this is a proxy for regional banks or banks that are holding on to the long bond, this is increasingly bearish, right? Because 10-year yields rising, bond prices down. The technicals are here again making sense. We talked about this a couple weeks ago. Descending triangle, losing the daily cloud. And it looks like we're headed back to Q4 2023 levels. And the question that I keep asking myself is, okay, how bad does this have to get for the Fed to do something? Or will the Fed just not do anything, right? Will the Fed just let this go into free fall? Everyone assumes, including myself, that the Fed will eventually have to intervene somewhere. I don't think the market is quite prepared for what the Fed won't do if things start to fall apart, if the wheels fall off the wagon. So maybe we do see a string of regional banks start to explode again. Maybe that's what it's going to have to take for the Fed to step in. We'll see. Looking at the risk markets, not really risk, but SPY, SPY, continuous bear div on this thing for months and months and months. You can't really use that as a top indicator while it's happening. Back to odds and probabilities, eventually you lose momentum. The bearish divergence kicks in more and more and more. And each week, each passing day, you sort of have to ask yourself, okay, we are 2 months, 3 months, 4 months, 6 months into a bearish divergence. Does it still look bullish here? It certainly didn't look bullish last week when we nearly fell 2%. Certainly doesn't look bullish today. on the daily Kijun. This could recover here. I don't think it's likely based on everything I've talked about in the video so far. And once again, the best trade is always going to be bullish Kumo breakout, bullish TK cross. So this is definitely not screaming a buy up here to me. Looking at the Williams fractals as a trailing stop loss, these weren't tripped until basically the top. So again, pairing this with the cloud with RSI on a technical basis, it's pretty simple. You might argue up in this region you got stopped out, but I would argue that the breach of the resistance fractal got you back in a few days later. So that's what you'd be looking for going forward. It would basically be a move about 520 or whatever the next resistance fractal forming might be. But here, I just don't see an argument. And you could say the same thing for the Qs, breaking below the Kijun, RSI just continuously curling down. Something else to watch for the SPY is oversold conditions on RSI. Watch for a bearish TK cross on the daily, right? All this stuff. It's going to take probably a couple of weeks, at least a week, I'd imagine, to reset everything, make a decision. Bearish targets would be 460 thereabouts on the SPY, 395 on the Qs, and much like October into November, again, that's the time to trade this, not here, not when things are rolling over, have been sideways for over a month and gone nowhere. And that's not even mentioning bearish chart patterns up here. IWM also looks completely tragic to me through the daily cloud here. This probably goes down to 185 at this point. You'll probably get a bearish TK cross on this today or tomorrow. These are the most rate sensitive names. So if these names in the index were expecting a cut, it makes sense that they roll over because we're not getting a cut anytime soon, most likely. And maybe it's max pain for 2 weeks. Powell comes out in May and says, guys, we're going to cut, and everybody celebrates, pops the champagne, and we reverse. But until that point, down certainly seems more likely than up. Moving on to the semis, again, it's all the same. RSI curling down, bear divs everywhere, bearish patterns everywhere. 6 months of up momentum coming to an end here. And it's just going to take time to heal the bearish reversal patterns that we're forming. This may not be the trend is over, it's all over type behavior, but in the moment, definitely feels like momentum has peaked. And quickly going through the Mag 7 here, NVIDIA, again, does not look healthy to me, does not look like anything anybody should be touching on the long side up here. Realistically, I don't think you can short this yet, but this does represent potentially head and shoulders type price action to me. Momentum clearly flat, clearly lost the blue line there, the Tenkin, and 670, 700 would be levels to watch on the downside. SMCI looks even worse to me, 720 or less, potentially on the downside. It needs to resolve whatever bearishness is up in this $1,000 range, head and shoulders all day on that thing. And the rest of everything, again, just looks like alts did on the crypto side Wednesday and Thursday. There's just, I don't see anything here that looked like it did in October, anything that looks like a breakout, anything that looks like momentum is regathering strength. Microsoft at the daily Kijun there, this isn't bearish, but it doesn't look amazing, right? Amazon has a lot to give back, potentially down to 171 on the Kijun there, but overall still looks pretty healthy relative to everything else. Meta potentially back down to 450. Certainly doesn't look like bullish continuation there. Massive bear div on that one. Google to me still looks okay. I don't think there's an issue in the long term. In the near term, this is going to sell off with everything else, but it would make sense to regather strength and then try for all-time highs probably later on this year. Once again, Netflix rolling over to me. Doesn't look like anything I want to touch. Apple's been bearish for over a month on the daily cloud, and definitely doesn't look bullish to me. And Tesla, worst of all of them. Big layoff announcements came over the weekend into this morning, and that chart looks ready for new multi-month lows, far below the daily cloud for many months now. So the worst thing you can do is ignore the trend. If you want to lose money, for a long time, just ignore the trend. Okay, the cloud is great at telling you what the trend is and great at giving you a heads up of where things might be headed. So this continues to look bearish to me. A few crypto names here. MSTR also has that SMCI head and shoulders, inverted Adam and Eve, whatever, just does not look bullish to me. Let everything reset. This is going to take potentially a month or more. Look at all these previous resets. None of these guarantee anything. You just want to make sure you're there when the potential for these moves happens. And this is not a bullish picture. Coin, similar. Long term, I like coin. I have no issues with a cycle hold on coin. But here now doesn't quite make sense to me. Again, inverted Adam and Eve, just kind of giving everything back over the past couple months. And let's say this is a trend channel, kind of a gross trend channel, where you're kind of ping-ponging overbought, oversold. Maybe something to watch for if this really gets cooking to the downside would be something sub 200. But here and now, I just don't see an argument to add to that name personally. And then WGMI, the miners, continues to look bearish, unfortunately, below the daily cloud here. And if we break that diag support, I think the next stop would be somewhere between 11 and 1150. So I don't bring great news today. I don't take any joy in that. Obviously, everybody wants to be right and make money, but there's really not many reasons in the moment to be bullish. This week is going to be challenging for Legacy to return to highs, I think. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.